Ladies and gentlemen, welcome to Dexlcast. Now, without further ado, I present to you Mr. and Mrs. Dexl.
Welcome back, Chads and Chadettes. You're tuned in to Dexlcast, the pulse of policy, liquidity, and the digital frontier. I'm Mr. Dexl.
And I'm Mrs. Dexl. It's great to be back.
Sitting across from me, ready to synthesize this torrent of data.
That's right. Bridging policy and people really understanding how these high-level regulatory shifts and institutional moves actually translate into market action. That's definitely our lane here on Dexlcast.
Exactly. And our mission today, it's laser focused. We've got a stack of sources from the last few days. We're covering everything from, well, the tightening market structure around that $115 K BTC level, all the way to some pretty tectonic shifts in institutional collateral policy and, of course, the regulatory landscape in DC.
Yeah, and we're really here to extract those key insights you need to, well, map the currents, as you like to say.
Yeah.
We're not just, reading off the headlines. We're really digging into the, so what? What does a new CFTC nominee actually mean for derivatives?
Right.
What's this surge in B2B stablecoin volume telling us about real commercial adoption? That's what we're getting into.
Okay, let's hit it then. The cold open hook.
Yeah.
BTC is pressing $115 K. ETF flows, stabilizing. On-chain heat, cooling down. The technical structure looks, well, it's solidifying.
Yeah, it looks pretty good technically.
But, and this is the big but, policy and power might just be the real catalyst this week. So let's map those currents. Okay, let's unpack this market structure first. We've seen some serious resilience above $110. Honestly, it surprised a lot of the doom and gloom crowd out there.
It really has.
And we know the macro sets the tone, but as I always say, macro sets tone, liquidity sets motion. And the liquidity, the positioning signals right now, they're really demanding our attention. Hashtag A, cycle health and accumulation signals.
Okay, so the first really big sign of underlying health, it's coming from the speculative side, actually. We're seeing this distinct cooling of the short-term froth. CryptoQuant's BTC heat phase metric, the one that tracks short-term leverage, exuberance.
Yeah, I know it well.
Well, it's actively approaching a bottom, especially after that flush we saw earlier in the month.
And that reset is historically, it's critical, isn't it? When that heat indicator bottoms out, the implication is usually pretty clear, a shift back towards accumulation.
Exactly.
It basically means the market's shaken out the, let's call them leveraged tourists.
Right, the weak hands.
And move control back to the higher conviction, long-term holders.
Yeah.
But for this accumulation phase to really hold, we need two things, right?
Yeah, definitely two key conditions. First, we need volatility to stay relatively low, continued low vol.
Okay.
And second, crucially, no new, completely unexpected global macro shocks. That's the wild card.
Right, no sudden curveballs from the wider world.
And that low volatility point, that's actually where the market narratives start to diverge pretty sharply. It creates this fascinating tension.
How so?
Well, you've got analysts like Joe Consorti pointing out that historically, unusually compressed volatility, especially when you're sitting right near all-time highs, is actually a strong bullish flag.
Okay, implying absorption.
Yeah, exactly. It suggests supply absorption is happening quietly, without panic, sort of pointing the market for a potentially high-velocity breakout.
But there's always a but.
There's always a but. You can't ignore the counter-narrative, which is really centered on external risk. Macro heavyweights, people like Tom Lee. They're still warning that if we see a broad risk sell-off across traditional assets, maybe driven by geopolitics, maybe bad economic data, Bitcoin isn't immune, we could still face potentially a 50% drop risk.
Oof, 50%, that's significant.
It is. So the technical setup looks really positive, suggesting upside potential, but that macro overhang is just massive. You've got to respect those invalidation levels.
Absolutely. Which brings us to contextualizing price calls, right?
Oof.
We have to talk about stock to flow as well.
We absolutely do. Bitwise Dragosh put out a really sharp, but I think necessary cautionary note on this. S2F has been, foundational for a lot of long-term Bitcoin believers. It projects that cycle peak around 222K based purely on supply dynamics.
Purely supply. having driven. But why is that model potentially flawed or maybe just incomplete this cycle? We need to unpack the mechanics.
Right. S2F fundamentally relies on the halving creating this massive inelastic supply shock. That's the core idea. But Dragosh argues, and honestly the data seems to back this up, that the sheer continuous structured demand coming from the spot BTC ETFs, it fundamentally changes the equation.
Ah, the ETF demand. It's just a different beast entirely.
It really is. The ETF demand structure, the daily creation and redemption mechanisms, dictated by institutional balance sheets, it now dwarfs the supply reduction impact from the halving.
Okay, dwarfs it. That's a strong word.
It is. S2F is basically a supply-only framework, and when you introduce this institutional bid, which is essentially mandated, daily buying pressure, well, the supply restriction just isn't the dominant narrative driver anymore.
So the conversation shifts.
Exactly. It's shifted from Bitcoin is scarce to, maybe more accurately now, Bitcoin is accessible collateral. Hashtag #TagB ETF, flow dynamics, and divergence.
And that accessibility, that's exactly what we're seeing play out in the flows, isn't it? That institutional bid seems highly focused, leading to this pretty distinct divergence between the top two assets.
Absolutely clear divergence. We saw the spot BTC ETFs post their second consecutive day of strong net inflow, pulled in a positive $90.7 million.
Consistency, that's key.
It really is. And the demand was concentrated too, led by the heavyweights Fidelity, BlackRock. It just confirms that institutions are using that ETF structure for continuous systematic exposure to Bitcoin.
Okay, strong BTC flows. Now contrast that with the US spot ETH ETFs. What are we seeing there?
Well, it's the opposite story, really. They recorded their third straight day of net outflows, totaling around $93.7 million out.
Wow, okay. Nearly $100 million out while BTC is pulling money in. That's a noticeable lag. Does this signal like fundamental bearishness on Ethereum? Or is something else going on?
It's a really important question. Is it a lack of conviction in ETH right now? Or could it be capital rotation?
Rotation back to the leader.
Potentially. Given the macro events looming that we'll get into later, maybe institutions are consolidating risk by rotating back into Bitcoin, the market leader. Or maybe they're simply digesting the supply from ETH's recent run-up, locking in some profits.
Could be either, really.
Right. But either way, the flow divergence confirms it. We're operating in a strongly BTC-dominant environment at this moment. We are definitely not yet in an everything goes up kind of market. Hashtag CFTC. Leverage and short-term roadmap.
Okay, let's zoom in on the short-term roadmap. BTC took back 112.12K, pushed firmly towards 150-ton-K. But this move, it was characterized by some pretty high volatility in the futures markets, right? Lots of fireworks.
Oh, yeah, absolutely. We saw rapid leverage flushing. I mean, we're talking massive hourly spikes, one totaling $175 million in liquidations.
Wow.
And then a follow-up flush of another $128 million liquidated across the major venues.
Painful for those caught offside, obviously.
Extremely painful. But, you know, this kind of rapid cleansing of open interest, it's actually a sign of market health in a way. It removes that excess risk, clears the decks, and allows the price to move more freely without the overhead of massive over-leveraged bets weighing it down.
Right, clears out the froth. Now, for tactical traders, a key point of focus has got to be the CME gap.
Always the CME gap.
The CME Bitcoin futures market, which is mostly institutional, closed Friday at $110,990. But then it opened Monday significantly higher, up at $113,495. That leaves about a $2,500 gap.
And we know these gaps, you know, where trading didn't actually happen, they often act as these psychological and technical magnets.
Traders watch them religiously for a potential gap fill. That $110,990 level becomes a very, very strong target for any short-term pullbacks.
Definitely, especially if the macro environment throws us a curveball later this week. It's an area where you'd really expect strong counter liquidity to step in. Okay,
let's look deeper at the positioning now. The aggregate BTC perp long-short ratio across the top exchanges. Where's that sitting?
It's hovering right around 4,951, so a slight short tilt overall.
Which is constructive, right? It shows the market isn't overly complacent or euphoric. That tends to be when you get those massive drawdowns.
Exactly. Not too hot, not too cold. But what's really fascinating is the visibility. We're getting into some smart money positioning. We tracked one prominent, high alpha trader who significantly ramped up their exposure.
How much are we talking?
Added nearly $340 million in BTC and ETH longs. And they're not afraid of leverage either, running 13x on their Bitcoin longs and 5x on Ether.
Okay, $340 million at 13x and 5x leverage. That's That's serious size.
It's huge. And positioning this large gives us these critical, visible liquidation bands. They basically act as ultimate lines in the sand for the market now. Roughly $77.7K for BTC and $2,777 for ETH.
Right. The moment the market sees positioning that large and leveraged, those bands just become major psychological support and resistance targets. Everyone's watching them.
Absolutely. And this influx of capital, it's reinforced that overall mood shift we talked about. The crypto fear and greed index moved back into neutral territory, sitting at 51.
Okay. Neutral. Not fearful. Not greedy.
But, and this is important, the altcoin season index remains notably low, still stuck down between 24 and 30.
So still very much Bitcoin's show.
Completely confirms the BTC-led environment. If you're looking at alts right now, you really have to be extremely selective. Focus only on those high alpha, maybe narrative-driven plays, because the general liquidity just isn't flowing downstream yet. All right, moving away from the charts now, let's step into the corridors of power. This week is really defined by policy decisions, both immediate and longer term. And these decisions are introducing, well, venue risk, and they're actively shaping the future operating environment for digital assets, especially in the U.S.
Yeah, focusing on that intersection of policy and people, as you say. But before we dive into the specifics of U.S. policy, we really cannot stress enough the immediate macro gauntlet that's facing us this week. These upcoming dates aren't just marks on a calendar. They're critical liquidity steering events.
Absolutely critical. They could determine if those positive ETF flows we just talked about stay positive, or if they flip violently negative.
The timing risk here is just immense. What do we got coming up?
Okay, line up. October 29th, we get the FOMC rate decision and, crucially, the press conference afterward. The market will be hanging on every single word about the future rate path.
Every nuance scrutinized.
Totally. Then October 30th is a doubleheader. The Bank of Japan decision, which is critical for global carry trade dynamics, and the preliminary US Q3 GDP print. That tells us how healthy the engine of the world's largest economy is actually running.
Okay, BOJ and GDP, big day.
And then wrapping up the month, October 31st delivers the US core PCE data.
The Fed's preferred inflation gauge. Why does core PCE matter so much?
Because it's the one the Fed watches most closely. If these prints GDP, PCE suggest inflation is still sticky, or maybe that growth is slowing down dramatically, well, traditional finance investors, they will pull their risk budgets almost instantly.
And that creates a cascade effect.
Exactly. A cascade that could hit high beta assets like Bitcoin really hard. These events dictate the posture of the US dollar, and the dollar is, at the end of the day, the ultimate liquidity arbiter for global markets. Hashtag PB US regulatory and infrastructure shifts. Okay. Shifting now to internal U.S. policy. The headline that really confirms that idea of power is policy comes from the energy sector. We saw the U.S. Energy Secretary send a very pointed letter urging FERC, that's the Federal Energy Regulatory Commission, urging them to greenlight direct access to industrial grid capacity for both Bitcoin miners and AI data centers.
Okay, miners and AI. Putting them in the same bucket for grid access, that's interesting. What's the significance? FERC regulates interstate power transmission, right?
Precisely. FERC regulates the transmission and wholesale sale of natural gas and electricity and interstate commerce. So if the energy secretary actually succeeds here, it's not just about miners getting potentially cheaper power, it's much bigger.
Legitimacy.
It's about regulatory legitimacy and operational stability. Getting priority grid lanes like this fundamentally reduces operational risk for U.S. hash rate. It helps stabilize costs, and it really encourages the consolidation of global mining dominance within U.S. borders.
Treating it like critical infrastructure, not just some, annoying load on the grid.
Exactly. It's a huge mindset shift. And this infrastructure piece ties directly into regulatory leadership changes. We saw President Trump nominate Michael Selig as the next CFTC chair.
The CFTC. Commodity Futures Trading Commission. Huge regulator, oversees derivatives.
Immense. Primarily responsible for oversight of derivatives and commodities markets.
So why does this specific nomination matter so much for crypto?
Because digital asset derivatives, we're talking futures, perpetual swaps, they are the absolute lifeblood of institutional trading in this space. And they overwhelmingly fall under the CFTC's jurisdiction.
Right. So the chair sets the tone.
The chair defines the agency's posture on market structure rulemaking, on asset definitions, crucially, the commodity versus security debate, on the rigor required for exchanges and venues to get registered.
So a clearer, maybe more permissive stance from Selig.
could dramatically accelerate things. The launch of new products, new venues, specifically catering to institutional U.S. clients who need that regulatory certainty, it's a really big deal for market structure. Hashtag C. Enforcement frictions and venue risk. Okay, but alongside potential clarity, we're also seeing significant friction internationally, especially around some of these newer, more novel business models. Look at Thailand.
Left-hand?
Their equivalent of the SEC, along with their Consumer Crime Investigation Bureau, conducted raids on nearly 100 WorldCoin iris-scan locations across the country.
Wow, 100 locations. What was the allegation?
Primarily unlicensed operations under their virtual asset laws. But the bigger picture here is this incident highlights the rapidly rising global scrutiny on combining biometrics with token incentives.
Yeah, the whole scan your eyeball, get a token model.
Exactly. Any protocol that requires that kind of physical data collection combined with a tokenized reward system, it's stepping into a regulatory minefield, especially in emerging markets where identity and privacy frameworks are still being hammered out.
So growing operational and compliance complexity for protocols, trying to onboard users physically like that.
Definitely. And we can't ignore the political risk premium bubbling up in Washington either. Representative Waters came out swinging, heavily criticizing the presidential pardon of CZ.
Labeling it how?
Labeling the situation as pay to play. And alleging ties between the pardon and lobbying efforts from groups like WLFI, Wall Street Leaders for Innovation.
Okay, strong words. Pay to play. Now, regardless of the political truth behind that.
Right, we're not taking sides, just reporting the friction.
That kind of noise has a real impact, doesn't it? It increases the political risk premium for all exchanges.
Absolutely quantifiable impact. When high-profile politicians publicly question the integrity of exchange leadership or regulatory outcomes, it sends cold shivers down the spines of traditional banking partners.
Makes them nervous.
Very nervous. It makes it exponentially harder for even the most compliant digital asset businesses to secure basic, essential services like stable, FDIC-insured banking relationships, or even just navigating the path for new asset listings. That political drama translates directly into operational friction and banking difficulty.
Okay, this next segment. This is where, for me, it gets really interesting. We're pivoting now to where institutional money is moving digital assets beyond just speculative holdings and integrating them into core credit infrastructure. It's shifting from just buying to actually leveraging and using these assets commercially. Hashtag A. Deepening institutional integration.
And the single most important headline reinforcing that institutional commitment has to be the news from JPMorgan.
What do they say?
The report that they are actively considering accepting Bitcoin and Ethereum as loan collateral, that is just monumental.
Okay, wait. JPM considering BTC and ETH as collateral for loans. That is huge.
Yeah.
Explain why that's such a step function unlock for credit.
Well, think about it. Until now, most big banks have treated digital assets as these isolated, high-risk, almost zero utility holdings on their clients' balance sheets.
Wait, siloed off.
Exactly. When a major Tier 1 global bank like JPMorgan starts seriously considering accepting them as collateral, it fundamentally changes their risk weighting. It grants them a new level of legitimacy within the traditional financial system.
So institutional holders can then borrow against their crypto.
Precisely. They gain the ability to leverage their digital assets without needing to sell them. This injects regulated systematic credit liquidity directly into the crypto ecosystem using the existing banking rails.
That's massive potential liquidity.
Huge. But for this to actually happen, JPM has to solve some significant hurdles. We're talking Basel III capital requirements, how to value this volatile collateral daily, securing robust regulated custody.
Not simple problems.
Not at all. But the fact that they are even considering it publicly signals they believe they've found a viable pathway through that regulatory maze. They see a way to integrate crypto as a legitimate, balance sheetable component, not just a speculative trade on the side.
Okay, so JPM signals the intent. What else are we seeing that facilitates this deeper integration? Licensing seems key.
Licensing momentum is definitely picking up. We saw Crypto.com apply for a U.S. National Trust Bank charter.
Okay, federal charter.
And simultaneously, over in Europe, the Swiss platform Relay secured a MiCA license.
MiCA, the big EU regulatory framework.
Right. And that gives them crucial cross-border passporting rights across the entire European Union.
So these moves provide the necessary regulatory cover for institutions.
Exactly. A U.S. National Trust Charter offers federal oversight. which is generally simpler and more prestigious than navigating 50 different state licenses. And that MiCA license transforms Relai from just a Swiss entity into a pan-European service provider. It significantly expands their protected distribution and custody options for EU institutions looking for regulated partners.
All right, let's talk stablecoins. We've talked for ages about them being the killer app.
We have.
But now we seem to have some hard, quantifiable evidence of actual commercial adoption. And it seems driven in part by regulatory clarity.
That clarity, yeah, particularly in the U.S. context, seems to be a major catalyst. There's data showing U.S. stablecoin payment volume has absolutely soared up roughly 70% in the 6 months after the passage of the Genius Act.
Okay, the Genius Act, now, that's a hypothetical framework in our source, right?
Yeah.
But let's assume it provided that clear regulatory environment. 70% growth is huge. What kind of volume are we talking?
Assuming that clarity was achieved, monthly volume moved past the $10 billion mark.
$10 billion a month.
But here's the really crucial data point. Roughly 2/3 of that volume is reported as B2B, business-to-business transactions.
Ah, okay. So this isn't just retail trading or DeFi yield farming.
Not primarily, no. This points towards real-world commercial infrastructure adoption. We're talking companies paying suppliers internationally, settling invoices across borders, managing corporate treasuries using stablecoins.
That efficiency must be attracting legacy players too.
It definitely is. Look at Western Union, a global remittance behemoth, right? They are actively piloting a stablecoin-based payment system right now.
Why would Western Union do that?
Their motivation is pretty simple. They want to circumvent the existing correspondent banking infrastructure, which is notoriously costly, slow, and involves multiple intermediaries.
Right, the old Swiss system can be clunky.
Very. By using stablecoins, Western Union aims to dramatically improve speed and, crucially, capital efficiency, especially in high inflation markets where holding fiat, even for a short time, introduces significant risk to their business model.
Interesting. And the stablecoin market itself, is it diversifying beyond just the US dollar?
We're starting to see signs of that, recognizing the global need for other FX pegs. We just saw the launch of JPYC.
JPYC, so a Japanese yen-pegged stablecoin?
Exactly, the first major one, and it's meticulously backed, they say, by bank deposits and Japanese government bonds, JGBs.
Okay, backed by JGBs. What's the business model there?
It's actually quite clever. They're planning to waive early transaction fees for users, making it attractive to adopt. Meanwhile, the issuer earns interest on the underlying JGB holdings.
Ah, so they capture the yield from the government bonds.
Right. Unlike U.S. stablecoins, which face increasing pressure to pass yield back to users, JPYC is testing if there's robust demand for a non-USD stablecoin backed by low-risk sovereign debt. It's a really critical test case for how global FX diversification might play out in the digital asset space.
Definitely one to watch. And speaking of issuers, what's the latest on Tether? They're still the giant in the room.
They are, and they're forecasting a massive profit this year, around $15 billion in net profit, largely driven by the high interest rate environment on their massive reserves.
15 billion profit. Wow.
That kind of profitability gives them a huge war chest, and they're looking to use it seeking investment partners to potentially issue a new, fully compliant U.S.-based stablecoin, maybe called USAT.
Okay, a regulated USAT from Tether, that would shake things up.
It signals a clear intent to compete head-on in the regulated U.S. market, which would directly impact the competitive dynamics for established players like Circle and others. Hashtag C, public market appetite, and L2 economics. So with all this institutional adoption and infrastructure build-out happening, how are the public markets reacting? How are they pricing this in?
Well, one clear signal is JPMorgan lifting its price target for Coinbase stock, CNN, all the way up to 404 PT.
404 PT on Coinbase. That shows pretty strong public market appetite for these regulated gateway businesses, doesn't it? The ones actually facilitating institutional entry.
It does. But there's maybe a deeper insight from a separate JPM analysis. This one focused on layer 2 economics.
Oh yeah, what did they find?
They estimated that if Coinbase were to actually tokenize their layer 2 chain, Base, that potential Base token could unlock up to a staggering $34 billion in additional value for Coinbase as a company.
$34 billion, just from tokenizing Base. How do they get to that number?
It's not just pulled from thin air.
Yep.
It seems to price in the future potential monetization of that L2. Things like governance rights, capturing a share of transaction fee revenue, maybe staking participation if it becomes decentralized.
Okay, so valuing the network effects and potential cash flows of the L2 itself. It's pretty solid evidence that traditional analysts are now actively integrating the value of these centralized exchanges, building and potentially monetizing decentralized infrastructure right into their core equity models. The tokenization of L2 value is becoming a recognized, quantifiable factor in TradFi valuations. All right, let's drill down now into the core tech, the builder's corner. We're seeing some major steps towards standardizing identity for autonomous entities, AI agents, and also some serious optimization of block space to handle the kind of throughput needed for global commerce. I'll focus on the tech primitives here. Hashtag A, on-chain AI agent identity.
Okay, so this convergence of AI agents and decentralized systems, it really needs clear standards, right, for trust, for interaction. And that brings us to the final specification of ERC 8004.
ERC 8004. What's its practical function? Why is it important?
Think of it as foundational plumbing. ERC 8004 provides a standardized framework for autonomous AI agents to do three key things directly on-chain: establish their identity, execute transactions, and maybe most critically, build up a verifiable reputation over time. Okay, identity, transaction, reputation. Without a standard like this, agents can't really securely interact across different protocols, can they?
Exactly, it would be chaos. The standard is basically essential infrastructure for the future agent economy people talk about. And on-chain identity is crucial for preventing things like Sybil attacks, where one entity pretends to be many, and also for ensuring the provenance, the origin of actions and data generated by an AI.
And is it seeing adoption?
Critically, yes. We're seeing Taiko, the L2, supporting ERC 8004 as part of its core infrastructure already. Getting this standardization in place now significantly simplifies how agents might interact across multiple chains in the future. It allows for the scaling of verifiable, trusted agent services, hashtag B scaling, and throughput upgrades.
Makes sense. Okay, let's talk scaling. Still paramount for adoption. Polkadot just hit a major milestone, right? Polkadot 2.0.
Yeah, they completed their major Polkadot 2.0 upgrade, and the highlight feature is something called elastic scaling.
Elastic scaling, what does that allow?
It's a pretty massive functional upgrade for their architecture. It allows Polkadot's block space delivered via their parachains to flexibly expand and contract their capacity based on real-time demand.
So capacity adjusts dynamically.
Right. This flexibility is really essential for handling the often unpredictable, bursty workloads you see from things like rollups. The projections suggest this could boost throughput and also improve cost efficiency for those kinds of workloads by up to 3 times.
3x potential improvement. That's significant.
It's a serious architectural change, clearly designed with handling future institutional and maybe high-frequency trading traffic in mind.
Okay, so that's Polkadot focusing on flexible throughput. Meanwhile, Solana's looking ahead too with their Alpenglow upgrade. When's that slated for?
The timeline looks like late 2025 or maybe early 2026, so still a ways out. But while Polkadot's upgrade focuses on throughput, Alpenglow seems more focused on the economics of decentralization.
How so? What's the core issue Alpenglow is trying to solve?
Primarily, validator cost. Apparently right now, the recurring costs just for validator vote fees on Solana are around $4,000 per month per validator.
$4,000 a month just for voting fees. That's a pretty high barrier to entry.
It really is. It tends to limit validator participation to only larger, well-capitalized entities. Alpenglow aims to dramatically cut those fees and also increase overall network bandwidth.
And the goal there is to
Broaden validator participation, make it cheaper and easier for more entities to run validators. If validator participation increases, the network theoretically becomes more decentralized and more resilient, even while they also work on enhancing throughput capacity separately. Hashtag C, liquidity and incentive rails.
Okay, makes sense. Decentralization and cost reduction.
Yeah.
Lastly, in the builder's corner, how is capital being used to steer adoption of new tech? Uniswap Foundation made a move.
Yeah, interesting one. The Uniswap Foundation committed up to $9 million. It's specifically to fund ZK-verified gas rebates for their new V4 hooked pools.
Okay, ZK verified gas rebates for V4 hooks. Break that down. Why is that needed?
So ZK verification, zero-knowledge proofs, they offer superior privacy and security benefits, which is great.
Yeah.
But they're also computationally demanding.
Meaning higher gas fees.
Potentially, yes. Which could make using ZK-enabled pools non-competitive for high-volume users like liquidity aggregators compared to maybe older, cheaper less private standards.
So Uniswap is basically subsidizing the ZK computation cost.
That's exactly what this $9 million grant does. It effectively pays to absorb that extra computational cost. The clear goal is to nudge those liquidity aggregators, the ones driving huge volume, to actually integrate and utilize the more advanced V4 hooked pools, including the ZK verified ones.
So it accelerates V4 adoption.
Right. And hopefully deepens the quality of on-chain liquidity by making these advanced privacy-preserving features financially viable right from the start. They're using capital pretty strategically here to overcome a key adoption friction point. Okay, amidst all this excitement, institutional optimism, cool tech upgrades, we absolutely must remain vigilant about the practical risks. It's really crucial that you, Chads and Chadettes, understand how to manage operational risk on exchanges and how to interpret those large capital movements we sometimes see. #, VEN, monitoring venue operational risk.
Yeah, absolutely. We've seen several, let's call them operational hiccups on exchanges recently. They serve as really essential reminders for users to stay informed about the venues they use.
Couldn't agree more. Users absolutely must plan their exits if needed and meticulously monitor any announced upgrade windows or maintenance periods.
What are some recent examples?
Well, we saw Bithumb temporarily pause withdrawals for SLF, apparently due to a chain halt on that specific network. That's a sudden loss of liquidity access for users holding SLF there.
Okay, chain halt risk. What else?
Bybit announced they're delisting the KD-DT spot pair. And Binance scheduled temporary suspensions for OM and EGLD for system upgrades and also for APE because of a necessary contract swap.
So the implication here isn't really about the underlying tech being bad. It's more about liquidity risk for the user, right?
Exactly. If you hold these specific assets on these specific platforms, these notices directly impact whether you can trade them, especially during potentially volatile periods, or if your capital might just be locked up temporarily. Managing operational risk means anticipating these pauses and maybe having assets on multiple venues or in self-custody if you need constant access. #, whale flow signals. And then there are the whale flows. We constantly monitor large capital movements, the whales, because they can provide strong directional signals. Although often the signals can be a bit mixed.
Right. What does the flow analysis tell us this past week or so? Any big moves?
Well, we tracked a known Bitcoin OG, an early adopter wallet, depositing another 100 BTC onto Kraken.
Okay, 100 BTC, is that significant in itself?
It's part of a much larger pattern we've been seeing. This specific OG activity is part of nearly $594 million worth of BTC that appears to have been distributed, moved, potentially sold by similar OG wallets over just the last 2 weeks.
Wow, nearly $600 million from OG wallets moving in 2 weeks. How do we interpret that?
It needs careful interpretation, for sure. Large deposits to exchanges often precedes sell pressure. Or at the very least, they might indicate a desire to hedge risk in what feels like a volatile environment.
Right, moving coins on exchange gives optionality to sell or hedge.
Exactly. Conversely, large withdrawals from exchanges usually imply holding, moving to cold storage for the long term, or perhaps executing large over-the-counter OTC trades that happen off the public exchange order books.
So this continuous distribution, almost $600 million over 2 weeks. What does that suggest?
It suggests pretty significant risk management might be occurring at the highest level, perhaps positioning for potential volatility around those big macro inflection points we discussed earlier, the FOMC, GDP, PCE data.
Getting ready for potential fireworks.
Could be. We also observe just generally massive BTC, SOL, and USDT transfers happening across major exchanges and even DeFi platforms like Alluve over the weekend. It just confirms that large players are actively, constantly adjusting their exposure right now. Nothing feels static. #7cut. Outro and final thought.
Okay, so let's try and distill this all down. What are the key takeaways from this deep dive? We've seen the market structure stabilize, definitely. Accumulation signals seem to be reappearing.
Technicals improving.
But it's happening right against the backdrop of this massive and imminent macro risk gauntlet this week. Huge event risk.
Yeah, tension there. And institutions signaled really powerfully by that JPM news about considering crypto as collateral. They're clearly moving towards embedding digital assets into core credit and lending structures. It's becoming infrastructure.
Right, and concurrently, policy is hardening. It's focusing on critical infrastructure like energy access via FERC and crucial leadership appointments like the CFTC chair nomination. The operating environment is really being shaped right now.
The foundations are being laid, for better or worse.
Okay, Chads and Chadettes, that's the flow for this week.
Yeah.
Those macro prints and the ongoing power policy plays, those are the tells this week. So manage your risk, Mind those CME gaps we talked about.
Definitely mind the gaps.
And we'll see you on the next Dexlcast.
Now, before we go, here's a final thought for you to chew on. Something to connect these policy shifts we discussed to the future of finance. Maybe stir the pot a little.
Okay, leave them thinking.
Given the massive potential institutional inflow that's signaled by JPMorgan, even considering BTC and ETH as collateral, how quickly do you think sovereign wealth funds or maybe major public pension funds might follow suit if that policy risk premium stabilizes, say under a new, potentially more clarity-focused CFTC leadership?
How fast does the really big slow money move once the regulatory path is clear and the banks are playing ball? Interesting question.
Something to think about.
Definitely something to think about until we next map the currents together on Dexlcast.